Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, we have Chris Engelbert. He's the managing director with Barron Wealth Consulting for our monthly registered investment advisor update. And we're also going to run through a number of charts for you. Chris, as always, great to have you with us. We have a lot to get through. And what's on retail investors' minds right now?
Well, right now, and I don't really want to call them fad investments, but the media has really been talking about, obviously, the cryptocurrencies and cannabis stocks. We've been getting a lot of calls from clients the last 18 months. What do I do with these things? How do I invest in them? How do they fit in my portfolio? And I just want to caution people, this is not a recommendation to buy or sell cryptocurrencies or cannabis stocks, but I really think what retail investors need to do is come up with an asset allocation or some type of strategy how these fit in their portfolio.
All right, so what is it, 5%, or is it just based, is it a percentage base, is it a dollar amount?
Yeah, I think, these are both new asset classes, if you want to call them asset classes, or strategies. You have to sit down and say, how much can I afford to lose if they would go to zero? So is that 2.5% of your portfolio? Is it 5.5%? But again, we're trying to get clients to recommend to clients that they have a strategy. So for example, if you had money in Bitcoin 18 months ago and it went from 8,000 to 18,000, your asset allocation percentage, if it was 2.5% of your portfolio, would have gone to 5%. Well, you should have some rules in place and say, okay, at 5%, I need to trim back, and you would have taken some profits.
Yeah, no, would you, so you have that on there, having rules in place to trim or to sell. Would you manage those investments differently than, let's say, a stock or a bond allocation? If you're, up 10, 20% in a position, you take out? Or is it different because they're riskier?
Yeah, it's different. They're riskier assets, but again, a lot of the different asset classes and your asset allocation really drives. We saw this back in the late 1990s when obviously the tech stocks were going wild and the dot-com bubble was going wild, and people would have an allocation of 10 or 15%, and it would go to 30%, and we'd go back to them and say, you really need to trim and take. It's all about managing the risk in your portfolio.
Okay, let's move along here and modernizing accounts. This
Yes.
is not your same portfolio as the 1990s, that's for sure.
Right. Well, one of the things that, everybody's trying to really modernize how they do business as an RIA firm, and a lot of people, we can send reports and we can do things via email, but one of the real bottlenecks in a business for a registered investment advisor is opening an account for an investor. So for example, you meet with the investor, they decide to come with your firm, you still have to do paper documents where they sign the custodial agreement, they sign the advisor agreement. You may have to send it out in the mail, it comes back. It could take 5 to 7 business days to open that particular account the way business is done now.
All right, let's take a look at a couple of the charts. We have a number to go through, the first one being the S&P 500. Quite the week to be here.
Yeah, so one of the things that we've been writing about for about the last month is we've had a really nice rally off the bottom. We were looking at 2,800. We expected some kind of 3 to 5% correction. We got that, and it was almost right down. It was almost a classic correction of 5%, and we've seen a really nice rally off the bottom.
Within a week.
Yeah, literally within a week. And that's one of the things that's a little disconcerting to a lot of investors is how quickly things are moving. But that's the age that we're in right now.
And you could take a look. Look at the chart right here. Things used to kind of ebb and flow. Your 8% average return on the year. Now it's just shot to the upside, shot to the downside, and there's really no longevity in these moves.
And again, we talk about managing risk. So at the end of December, our indicators were extremely compressed. We were pushing and upping our equity allocations for our clients. About 2-3 weeks ago, for aggressive accounts, we began trimming, taking some money off the table. But again, we used actually this week for those clients that were underinvested to get them back invested in the markets.
All right, let's take a look at the Nasdaq comp. Similar chart.
Yeah, what goes up faster comes down a little bit faster. So the recent correction, the Nasdaq's been about 6.5%. Again, this is a big cap technology-led rally. Make no bones about it. That's where all the action is right now.
All right, moving along to the Russell 2000, a little bit of a different story here. Particularly, these companies are caught within the crossfires of the trade disputes.
Yeah, you would think. Now, some people get very bearish when they see that the underperformance of these particular stocks or this particular sector. You can see the high was made last in August. It went down in December like the rest of the stocks. It really hasn't rallied. The correction was, again, this most recent correction was 6%. But, we again think you have to focus on where the money's going. And if the money's going to big cap stocks, you got to rotate your portfolio, and that's where the party is.
All right, and let's move along to the 10-year. A lot of conversation around that this year, but it's been kind of quiet.
Yeah, well, most recently you can see that we're kind of testing the lows. And again, a lot of market pundits this year were talking about, it looks like the economy may heat up and interest rates may go up again. They haven't. And so a lot of the stock market bears and the bond bulls are saying, well, hey, lower interest rates means that there's some type of recession or slowdown in the economy on the horizon. We don't think so. We think what's happening is that there's a lot of demand overseas where yields are in the negative rate zone, and those foreign investors are coming over and buying U.S. Treasuries, and they're keeping rates compressed at this particular time.
And you know what? They probably will be depressed at least through the election in 2020. They are not going to move. That's the indication I'm getting anyway. All right, let's wrap it up here. Let's take a look at crude oil. You would think that there'd be a little bit more volatility in it considering what's happening with Iran.
Yeah, again, we're very bullish on crude this year. We think it's going to, it's in the middle of taking a breather right now. We actually think that there could be some supply constraints in the near future. A lot of people don't realize that globally, we're starting to see demand, pick up a little bit more. We're still forecasting the mid 70s to high 70s range, very similar to where we ended or where we were in the middle of last year.
Yeah, you know what though? I will counter you on that one. You would think, again, through the 2020 elections, they're going to want to keep oil prices a little bit low. You don't want anything impacting the consumers' pockets.
True, exactly.
So, all right, Chris, as always, thanks for joining us. We'll see you next month in June. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.